Welcome to a Wednesday edition of the Wise Old Owl Show. This is episode 122, and boy, a U.S. bank collapse, and this could very well be the reason Canadian homeowners celebrate. We're going to talk about that in a minute. We're also going to talk about the high level of credit card use and what the Equifax report has come out and told us. All this on episode 22. I'm Vince Gaetano. Thanks for joining me. I really appreciate everybody tuning in on the Wednesday show. As you know, I usually have this show on Thursdays at 4 p.m., but I'm heading out of town with my son for a little R&R tomorrow, so I will be in transit and wanted to commit to having the show with you all. So Silicon Valley Bank collapses in the U.S. and it creates a shitstorm in the markets. Bond markets come down. And is this reason for Canadians to rejoice, put up a toast, and celebrate? It very well may be the catalyst to holding off on further rate hikes, and we could very well see some fixed rates start moving down in the coming week or two as banks start seeing that the bond rate is settling. So just to give everybody an indication, last week, the 5-year bond was sitting at about 342, down from about 360 at the peak in recent memory. And it's now down to 288, a 54 basis point drop, which gives me reason to believe that we could start seeing rates level off, and it's an indication that further rate hikes aren't coming, which bodes well for everybody. On the Bank of Canada front, I think what it's indicated is that these rapid interest rate hikes has done the trick. It has created some problems in the market. And when I always talked about these sudden rate hikes and the level of these rates are at a point where things are going to start to break, well, this is what I mean. A bank failure in California, something 4,000 miles away, and it's impacting Canada. So this is good news. I think, not good news for the people involved in that bank, but good news for Canadian borrowers, because we have probably seen the end of hikes. Now it's a matter of how long do they stay at this terminal rate. And unless there's going to be some other data that I think the February inflation number comes out next week by Stats Canada, so we'll look into that next week. But it's clear, it's very clear that we're probably at the terminal rate with the Bank of Canada. So good news for those that were worried about further hikes and seeing how it's impacting families. But I want to bring up some interesting points on some data that came out. So the saving rate in Canada was always around 2 to 3%. It was always very low. And during COVID, it jumped up to 27%. People couldn't spend any money, couldn't go anywhere. So the savings rate was at a ridiculous level. It's slowly coming down and it's hit 6%. And it's creating some concern because it looks like everybody's scraping through all their savings. Now, I want to talk a little bit about credit. Equifax came out with a report just recently. Credit card debt is up 15% in quarter four. Okay? That is significant, very significant. And to put things into perspective, prior to COVID, the credit card balances was sitting at around 90 billion in Canada. And during COVID, it actually dropped down to 73 billion. That is a significant drop. But it's now creeped up again. It hit 93 billion, and now Equifax is reporting that for the first time ever, it reached over 100 billion in credit card debt. So we have now gone about 10 billion above where we were pre-COVID. Okay? It's about 11%. Very concerning, because what we're seeing on the mortgage side is people really struggling to make payments, okay? Especially those in variable payments. So to just do a recap of some stats that I've shared with all of you folks in the past, 36% of mortgages are in variable mortgages. 45% of all non-mortgage debt is in HELOC, so home equity lines of credit, also a floating rate. And we have 1.1 million people maturing their mortgage in 2023. All those folks, all three of those buckets, are going to see interest rates more than double, in some cases 2.5 to 3 times what they were paying just 12 months ago. So this is very concerning, because what you're seeing is everybody's scraping by. Everybody's ripping through all their savings to deal with that increase in debt cost, okay? And just to put things into perspective, a year ago at 1.5%, people are paying, on $500,000, $7,500 in interest cost. At 4.25 points higher on $500,000, that's an extra $20,000 in interest cost. So it's starting to create a dent in the disposable income that people have for discretionary spending. And we are actually starting to see people just rip through all their tax-free savings accounts, RSPs, any savings that they have. They're ramping up credit cards. And listen to what we're seeing from Equifax. More than 1.4 million new credit cards were issued during the fourth quarter. So people were starting to access more credit, okay? And it's contributing to higher balances. The proportion of non-mortgage consumers who missed a payment on credit products in Q4 was up 11%. With a mortgage up 6%. The delinquency rate amongst those without a mortgage, the delinquency rate among those aged 18 to 25 rose over 31% year over year, and 17% across all consumers. So almost 1 in 5 consumers are experiencing some form of delinquency on their credit. Credit card usage remained high. More than 300,000 more consumers using their cards and carrying a balance on it than before. That's over 250,000, almost 1/3 people are using their credit cards and carrying balances that were never doing that before. So they're making up the shortfall in cash flow. People are running out of money before they run out of month. And that monthly income is getting depleted with all the extra costs of groceries, fuel, how the carbon tax is kicking in, the cost of debt is really making an impact, and it's concerning. So this is quite telling as to what we're going to be experiencing. I don't know if anybody has any questions, but this is not going to bode well. But as I said at the top of the show, the Silicon Valley Bank that collapsed is going to be something to celebrate for Canadian consumers, Canadian homeowners, because it probably means an end to further rate hikes. So the bond market dropping like a stone, it's down to 288. We should start seeing some of the banks cut some of these fixed rates unless they're looking for a risk premium in there. Hopefully they'll pass it on to the consumer. But remember, banks are very slow to decrease, very quick to increase. So we got to wait a couple weeks to see if these rates are sustainable, unless it's just a short-term blip. So we'll see how the bond market works. But very, very interesting. A lot of calls this week, and it's just a short one. People still in trouble. We still have folks looking to buy property. Appraisals don't seem to be coming in at the levels people are expecting, causing a bit of a cash crunch. People are having to come up with a difference to close on these homes. Still a lot of conditional financing offers out there, but there's no supply. This is really still an issue of supply. There's not enough out there. Realtors are still listing properties below what they're expecting, trying to generate that activity. So it's an interesting time. We've got a question here from Kush Stream. Do you believe this is just the beginning of a financial crisis? Well, I think the Canadian banking system's fairly safe. It is somewhat of a monopoly to a degree. And the credit criteria that they're using is tight. The stress test, as I've told you many times, I think that's going to be the unsung hero in all this. Although it was vilified in the past, I think it's done some good. The problem I see with the banks up here are the high level of static mortgage payments for their variable products. I really think that's an issue, but I do believe these banks have the tools available to them to stretch those amortizations as far as they want. And I think OSFI doesn't have a choice but to give them the blessing to do that. So, we'll see how that plays out. Although it's not a very good tale, if people have to make interest-only payments, they will. But there are going to be a few that struggle. There are going to be a few that got into this game under the impression that values just go up really quickly. And now that these higher interest payments are putting a strain on their cash flow and they don't have the available resources, i.e. savings accounts and little emergency funds to help them, they might have a hard time getting through this, because I think this is going to be a long run. I really believe we could very well see this play out over the next year and a half, maybe as long as 2 years before we get back to something more reasonable. So I don't think it's a crisis per se, but I think it will move us into a recession. I do believe we're going to have some tough times ahead. And as I've always said, tighten the chin strap on your helmet. It's going to be bumpy. Just let's figure out how to get to the finish line. Get that cash reserve in place. Make sure you focus on the needs. Get rid of the wants. Buckle down. Let's budget. Let's figure out how to get through it. And whatever we could do at Owl Mortgage to help you out, please do so. I am launching a YouTube channel called Owl Mortgage. I really hope that you folks could subscribe to it, and I'll try to put more content on there that would be shorter type clips to help you all out. And I got a whole bunch of requests for content, so I'm going to try to fill that up over the next little while. So thank you for that question. We'll see if there are any other ones, but got another big crowd here today. I'd really like to hear if anybody's run into folks that are struggling as well. Real estate fan. How and when do you see sizable uptick in inventory? Costs are up, but people are holding on for now. Surprising at this point, it's slim pickings from a buyer perspective. People that are in trouble are going to try to hang on. I really believe there are a few people that are hanging on longer than they should, and it's eroding equity. Like, I'm seeing people going from prime mortgages to alternative to privates renewing into other privates or refinancing into other privates. That's not a good progression. It should be graduating. You should be rehabilitating your mortgage journey, right? You should be going from high interest rates to lower interest rates to improve your situation. When you're going backwards, all that does is it erodes your equity in your home and it postpones the inevitable. So I think there are going to be some people hitting that point of no return in the second and third quarter, and it should yield more listings. Now, on the condo side, I do believe we're going to see a flood of listings, because those folks that bought 4 or 5 years ago are now going to be closing. 2023, we have, I think, 32,000 condos that are going to be delivered and registered. I do believe the majority of those are investors, and their cash flow situation is upside down relative to what they thought it was going to be 4 or 5 years ago. So they're having a hard time cash flowing. They're going to be in a negative position, and a lot of them don't even have an assignment market to sell these units in. So we could see a flood of those type of properties. But then again, the majority of those are one bedrooms, 1+ den. I don't think we're going to see a whole lot of activity. There could be a little correction in that market. We haven't seen it yet because there's still slim pickings out there, but we're probably going to see a few more on the market very, very soon. Okay, we got a few questions here. Wow, folks, big crowd. What do we got? Hopefully that answers your question. Relief for fear of missing out, guys. Yeah, you know what? If you are a qualified borrower and you are looking to buy a home, be very patient. Try not to get roped into a bidding war. I'm still concerned about phantom offers trying to drive prices up. I always think that's kind of strange where, something's sitting for a while, you call them up and all of a sudden there's 2-3 offers. Like, come on, give me a fucking break. Like, how is it a coincidence that once you're interested in a property that's been sitting for a while, there's all of a sudden a flurry of activity? But then again, just be patient, wait. Things are in your favor. There's not going to be a lot of you qualifying at these rates, so just be very, very wary. O'Neill 07, so does this mean if you're not currently a homeowner, then you should wait a couple years before buying? If you're not a homeowner, you're not going to be under a lot of stress, okay? Because remember, there's a big chunk of people that don't have mortgages. There's another chunk of people that rent, and their annual rent can only go up, their monthly rent can only go up once a year by 2.5% set by the landlord-tenant board, right? So, they're in good shape. They don't have the stress of increased costs like property taxes, maintenance fees are going up. Folks need to remember that shooting up in Vaughan when that condo owner went on a shooting spree of the condo board, God rest their souls, it created a huge tsunami of resignations from voluntary board members. Many board members said, you know what? If this happened there, who knows what can happen in my building? I'm resigning. And all of a sudden, they might have to move to a paid type of board, which only increases costs of the maintenance fees, and it just increases the whole structure and the maintenance of that program, of that property. So everything's going up. So, being a renter isn't a bad thing. It gives you an opportunity to save. And with rates moving up, it works out well on your savings accounts. You get to earn a few things. GTA real estate investor, do you think the big banks will pass on lower fixed rates based on the lower bond yields? However, the Bank of Canada rate decreases won't be as fast. Does it make sense to have widespread between fixed and variable? Well, the yield curve is inverted right now. Short-term rates are significantly higher than the 5-year. Banks are very reluctant to pass on savings, especially in these difficult times. They're factoring in a risk premium in their pricing. They need to increase their NIMs. NIMs is an acronym for net interest margins. Okay, when they aren't putting on as many mortgages as they used to because the flow of new businesses is coming to a sudden halt, right? Because it's not a flurry of activity right now. How they make up their spread is by their profits is to increase the spread. So my guess is because we don't have a fluid mortgage market right now, you're starting to see lenders increase their spreads between the cost of funds and what they're charging clients. And a lot of folks can't go elsewhere, right? So they know they're trapped. They're not having to aggressively price these things because it's tougher to qualify. So it's an interesting time. Is it opportunistic on the bank's part? Yeah, I would say that, but they're in the business of making money. Make no bones about it, okay? Banks are in the business of making money. They have their nice comfy couches. They tell you you're richer than you think, but at the end of the day, they're there to make money, okay? They're a servant to their investors, the stockholders. And their stockholders want dividends, they want stock appreciation, they're going to continue to drive revenue. So don't be surprised if the spread does widen. Okay? Hopefully that answers your question. Nikki, you know how it works. It takes a long time to drop, and it takes minutes to increase rates. So rest assured, banks know how to make money. So, we had some good questions today. As I said, there's not going to be a show tomorrow. I moved it up a day because I'm taking a little R&R with my son. We're heading out of town. And I want to thank everyone for tuning in. And as I always tell you folks, be kind to each other. There's a lot of people struggling. I gather 1 in 4 people are struggling out there. So if you have the opportunity to buy them a coffee, buy them a lunch, buy them a meal, give them a hand, please do so. They're hiding underneath that shield of, pride, and they're probably not going to tell you the situation they're in. So, when you're out in the crowd and you're out with 4 or 5 folks, chances are 1 of them could be struggling. And if you have the wherewithal and the means to give them a hand, do so. The Porsche Tracker. Holy shit, almost forgot that. So last week, the Porsche Tracker took a dive. It went from about 1,100 down to 1,076. It's back up this week. It's up to 1,089, 15.4% higher than where we started last September. Thanks so much for pointing that out. I almost forgot about that. We're starting to see people struggling. We're starting to see those credit card limits stretched. We're starting to see delinquency on the credit card and car loan front. And people are scraping by. So if you do need help, you have a client or a friend that needs assistance, needs to restructure something, please feel free to reach out. Please feel free to give my office a call. Pass along my name, pass along our info. We'd be happy to help them. But I'm not going to be here tomorrow and Friday. I'm going to be on vacation and back at my desk Monday morning. So we had a couple of questions here. Porsche Tracker. How to get a mortgage via corp a first-time investor? Okay, everybody asks this question, okay? There are lenders that offer mortgages via corp. You're always going to provide a personal guarantee. You can't get out of it, okay? So what I always tell people is, why is there this lure to put your property in a corp? Put it in a personal name with a trust agreement confirming on the day of transaction that you are the beneficial owner, the corporation is the beneficial owner, and you're just acting as a trustee. You save a lot of money and you got more options available to you, okay? So if you need help with that, give our office a call. We'll be more than happy to help you out. A lot of them are hiding their struggles. You're absolutely right. Lots of consolidation mortgages. Yes, we're seeing a lot of refis. When's the best time to pick up that Porsche? Wait, there's going to be a lot available. Ange 8020, hi, not sure if my question went through the first time, but here it is again. How's the Porsche? Okay, we got the Porsche Tracker, Ange. Thanks a lot. Thank you, all of you, again, for tuning in a day early. Episode 22 of the Wise Old Owl Show. We're going to finish it up. Help anybody you can. Be kind. And we'll see you next week. Enjoy the weekend. Take care. Bye.